Jeffrey Skilling, now a free man after spending more than a decade in federal custody. In 2006, he was convicted of conspiracy, securities fraud, insider trading, and lying in connection with the 2001 collapse of Houston-based energy giant Enron.
In the months before Enron collapsed, employees were still coming to work every morning. The building was open. The lights were on. Meetings were being held. Executives were telling staff that the company was dealing with temporary problems and that things would stabilize soon. Some people believed it, others didn't. But most of them stayed because walking away would mean accepting that everything they had worked for might already be gone. At the same time, executives were quietly doing the opposite. They were selling their shares. They were moving money. They were preparing for outcomes they were not sharing with anyone else. Publicly, they spoke about confidence. Privately, they were calculating damage. This difference between what was said and what was done wasn't new. It had existed inside Enron for years. By 2001, it was simply impossible to hide anymore. What made Enron dangerous wasn't secrecy. Plenty of companies keep secrets. What made Enron dangerous was how normal the situation felt to the people inside it. The systems were complex enough that very few employees could see the whole picture. Outside the company, analysts struggled to explain how Enron actually made money. When the collapse came, it didn't feel like the end of a bad company. It felt like the end of something people were told to trust. This story doesn't begin with fraud. It begins with a hunger for control far greater than the business beneath it. Enron did not begin as a high-profile company. It started as a product of consolidation in the energy industry. In 1985, two pipeline companies named Houston Natural Gas and Internorth merged to form Enron. The business was straightforward. It owned and operated natural gas pipelines and earned steady revenue by transporting gas from producers to utilities. One of the key figures behind Enron's formation was Kenneth Lay. Lay had a background in economics and government. He believed strongly in deregulation. He viewed government control of markets as inefficient and believed private companies should be allowed to negotiate prices freely. During the late 1980s and early 1990s, that belief began aligning with policy. Energy markets in the United States started to open up. Instead of fixed pricing, companies could now buy and sell natural gas under negotiated contracts. This introduced volatility. Most energy companies treated this shift cautiously. Enron treated it as an opening. Lay believed Enron could do more than move gas through pipes. He believed it could sit in the middle of the market. Instead of owning energy assets alone, Enron could match buyers and sellers, manage contracts, and earn fees without taking on the full risk of production. The idea itself wasn't illegal. What made Enron different was how aggressively it pushed the concept. Enron began presenting itself less as an energy company and more as a market maker. In 1987, internal auditors uncovered something that went beyond routine sloppiness. Traders Louis Bourget and Tom Mastrini had been running unauthorized trades and routing money through undisclosed bank accounts, including one at Eastern Savings Bank that sat completely outside Enron's normal reporting systems. Money was moving without oversight. When auditors flagged the issue, it wasn't framed as a minor compliance failure. It looked like a warning about what this business could become if it scaled without discipline. The problem reached Kenneth Lay. This was a quiet moment, but it was decisive. Enron stood at an early fork in the road. It could treat trading as a tightly controlled tool, impose hard limits, and rebuild the system from the ground up. Or it could treat trading as a profit engine, something messy, volatile, but powerful, where results mattered more than process. Enron chose the second path. Bourget and Mastrini were eventually convicted for fraud related to their trading activities. But the deeper lesson wasn't that two traders broke rules. It was how the company responded. Enron didn't step away from trading. Instead, it absorbed a softer conclusion. Problems were unacceptable only when they threatened earnings or reputation. If the numbers still worked, the system could tolerate a surprising amount of risk. That response set a pattern. Trading wasn't treated as a dangerous experiment that needed constraints. It was treated as a glimpse of the future. That future depended on something subtle but powerful. If Enron wanted to scale, it needed leadership that didn't see this as a side business, but as the core identity of the company. That leader was already there, waiting. When Jeff Skilling entered Enron's orbit, he wasn't hired to tweak a pipeline business. He was brought in to redesign what Enron was. In 1989, while consulting at McKinsey, Skilling pitched an idea Enron branded as the gas bank, an intermediary model where producers could deposit gas supply and buyers could withdraw it, with Enron standing between them to stabilize pricing and manage risk. The key shift wasn't the metaphor. It was the implication. If Enron could reliably intermediate gas contracts, then natural gas could be treated less like a physical commodity business and more like a financial market. Enron adopted the gas bank concept, and Skilling joined the company to run that trading operation that later dominated Enron's identity. Enron's new trading business created a problem. The company signed long-term contracts, but the real cash would come years later. Traditional accounting only counts profit when the money actually arrives. That didn't work for Enron. So they used mark-to-market accounting. The moment a contract was signed, Enron estimated its total future profit and recorded it immediately. On paper, the deal looked profitable right away, even if the cash wouldn't come for years or never. This made Enron appear like a fast-growing company, even when the underlying business hadn't yet delivered real money. Enron informed the SEC's Office of the Chief Accountant, by letter dated June 11, 1991, that it intended to use mark-to-market accounting for the natural gas trades of its newly formed subsidiary, Enron Gas Services. Under that approach, when Enron entered a gas contract, it would book the present value of estimated future profits at inception instead of waiting for actual performance and cash receipts over the contract life. The SEC ultimately issued a no-objection approval, allowing Enron to apply mark-to-market to its natural gas trading activities. Inside Enron, the company adopted a forced-ranking performance culture, often called rank and yank, where employees were graded on a 5-point scale and then stacked against each other. In one widely reported breakdown from 2001, the top 5% were labeled superior, the bottom 15% needs improvement, and those at the bottom faced pressure to improve quickly or exit. The crucial feature wasn't the labels, it was the fixed distribution. Even if a team performed well, someone had to land in the bottom bucket. By the late 1990s, this combination had redefined what Enron was optimizing for. The company's reported success could accelerate even while underlying projects and cash generation struggled, because the system rewarded the appearance of profitability at the contract signing stage. In practical terms, Enron's growth became less about building durable operations and more about keeping the machine fed. It also meant something else. Once Wall Street came to expect a constant stream of earnings and expansion, failing to meet those expectations would no longer be a normal business problem, it would be an existential one. From here, the next phase isn't about one decision. It's about what happens when a company built to manufacture earnings has to keep manufacturing them while the underlying economics get harder to defend. Several of Enron's largest projects were structurally unsound from the beginning. The most damaging was the Dabhol power project in India. Enron invested roughly $2.7 billion in a massive gas-fired power plant under long-term contracts that assumed the Indian State Electricity Board would buy power at prices far above what the local economy could support. Almost immediately, payment disputes arose. Political opposition intensified. By the late 1990s, Dabhol was effectively non-operational. Under conventional accounting, Dabhol would have forced Enron to recognize major impairments. Instead, Enron had already recorded future profits from the project years earlier. Writing down the asset would have meant admitting that previously reported earnings were fictional. So Dabhol remained on the books at inflated values while real cash losses continued to accumulate. Dabhol was not an exception. Similar problems emerged across Enron's international portfolio, in South America, Europe, and parts of Asia, where Enron had entered complex energy projects in unstable regulatory and political environments. By 1999, the gap between reported earnings and economic reality had become too large to manage through valuation alone. This is where Enron crossed a second, far more dangerous line. The company began actively removing losses from its balance sheet. That task fell to Chief Financial Officer Andrew Fastow. His solution relied on special-purpose entities, partnerships that if structured correctly did not need to be consolidated onto Enron's financial statements. In principle, SPEs were legal and commonly used. In practice, Enron used them to defeat the purpose of consolidation rules. The basic mechanism worked like this. Enron would transfer underperforming assets or loss-making investments to an SPE at an inflated price. Enron would record the transaction as a sale. The SPE in turn would absorb the loss. To qualify as independent, accounting rules required that at least 3% of the SPE's capital come from an outside investor at genuine risk. Enron complied on paper, but not in substance. Fasto pushed the model further by creating SPEs that he personally controlled, most notably LJM1 and LJM2. While serving as Enron's CFO, Fasto negotiated deals between Enron and entities he managed, earning tens of millions of dollars in personal compensation. These partnerships were presented to Enron's board as necessary risk management tools. In reality, they were used to warehouse losses and manipulate earnings. Banks played a critical enabling role. Major financial institutions structured transactions that were designed to appear as asset sales or hedges but were economically loans. These deals allowed Enron to receive cash while avoiding debt classification. The risk to the banks was minimal. The risk to Enron was deferred and magnified. At the same time, cash flow from operations was deteriorating. But Enron's reputation remained strong. Internally, the risk was well understood. Enron had locked itself into a system where survival depended on momentum. The company needed new deals not just to grow, but to cover what already existed. By early 2001, Enron's survival hinged on a fragile equilibrium. Its reported earnings depended on a rising stock price, uninterrupted access to credit, and counterparties willing to continue transacting despite growing opacity. None of these conditions were guaranteed. When the balance shifted, the company unraveled with speed that surprised even those closest to it. The first external shock came from California's electricity crisis. Following deregulation in the late 1990s, Enron became one of the most aggressive traders in the state's power markets. Internal trading strategies later revealed through recordings and memos showed deliberate efforts to create artificial shortages by exporting power out of California during peak demand and re-importing it at higher prices. Financially, California was devastating. Estimates later placed the cost to the state at roughly $40 billion. Politically, it drew national attention. Regulators began examining Enron's trading behavior, and its role in the crisis undermined its image as a neutral market maker. At the same time, Enron's internal financial position was deteriorating. Cash flow from operations was weak. The company relied increasingly on asset sales and short-term financing to generate liquidity. In April 2001, during an analyst call, CEO Jeff Skilling reacted angrily to a question about transparency. Enron's leadership was no longer confidently managing perception. The calm certainty that had shielded the company for years was breaking.
You're the only financial institution that can't produce a balance sheet or a cash flow statement with their earnings.
Well, thank you very much. We appreciate it.
Appreciate it.
Asshole.
On August 14, 2001, Skilling abruptly resigned as CEO after only 6 months in the role. No detailed explanation was offered. His exit suggested that senior leadership no longer believed the structure was sustainable. Kenneth returned as CEO the following day, attempting to stabilize the situation. Sharon Watkins, a vice president within Enron, sent Lay a memo outlining the risk that the company could implode in a wave of accounting scandals. She specifically referenced the off-balance sheet partnerships and warned Enron. The memo was treated as a legal and reputational risk to be managed, not as a signal to unwind the underlying structures. In October 2001, the external collapse began. Enron announced a $1.2 billion reduction in shareholder equity, largely tied to special-purpose entities. Shortly afterward, the company restated earnings for the previous 4 years, admitting that profits had been overstated. The market reaction was immediate. Enron's stock price fell sharply. Losses rushed back onto Enron's balance sheet. Credit agencies downgraded the company to junk status. Trading partners demanded collateral that Enron could not provide. As investigations intensified, Enron's accounting firm, Arthur Andersen, began shredding documents related to Enron audits. While the firm later argued this was routine document retention, the timing proved fatal. Andersen was charged and convicted of obstruction of justice, which destroyed the firm's reputation and effectively ended its business. In December 2001, Enron filed for bankruptcy protection, at the time the largest corporate bankruptcy in U.S. history. Roughly 20,000 employees lost their jobs. Many lost retirement savings while executives sold substantial portions of their own holdings in the months leading up to the collapse. The legal aftermath unfolded unevenly. Andrew Fastow pleaded guilty to conspiracy and fraud. He was sentenced to prison and forfeited $23.8 million. Several bankers involved in structuring Enron's transactions were convicted. Jeff Skilling was found guilty on multiple counts of securities fraud and insider trading and sentenced to 24 years in prison, later reduced. Kenneth was convicted but died of a heart attack before sentencing. Enron didn't collapse because of a single crime or revelation. It collapsed because its system converted assumptions into profits while postponing consequences and prioritizing appearance over reality.